The most dangerous moment in any bull market isn't when fear is loud, it's when fear goes silent, when prices climb in slow, hypnotic steps, when headlines stop asking questions and start telling a story, when one idea becomes the explanation for everything. Today, that idea has three letters: AI. It's the miracle, the moat, the master key. It explains the earnings, it explains the multiples, it explains why the rules don't apply until they do. Markets don't break because technology is fake. They break when belief outruns verification, when the cash flows don't match the courage, when a narrative meant to describe reality starts replacing it. We've been here before. In 1929, it was a new era. In 2000, the internet would rewrite economics. In 2008, risk had been engineered. Every time, the same scaffolding appeared: a compelling story, abundant money, and risk that collects in the same corners of the map. The story lifts prices. The money keeps the story alive. The concentration makes everything fragile. Look beneath today's rally and you see the pattern: clear, elegant, uncomfortable. Leadership narrowed, valuations stretched, promises stacked higher than proof, a handful of names carrying the weight of an entire index, while the rest of the market huffs in the background. That isn't doom, it's physics. Put enough load on a single beam, and the whole structure learns its limits. AI might transform the world, but markets don't pay for might. They pay for cash, sooner rather than later. The longer the timeline to monetization, the more sensitive prices become to small disappointments: a product delayed, a guidance line softened, a regulator asking for a closer look. In frothy regimes, the sentence, "Wheel pace investments can move billions in minutes." Listen carefully to the stories that hold the ceiling up. The first story says scale will conquer cost. Train bigger models, build bigger data centers, buy bigger power footprints. Unit economics will bend, maybe, but if costs refuse to fall as fast as prices, the math that justifies the multiple turns brittle. The second story says productivity will explode, output per worker will rise so quickly that profits will catch up to valuations, maybe, but productivity revolutions arrive unevenly, then all at once, years late for most, right on time for a few. Markets, impatient by nature, try to harvest next decade's gains this quarter. The third story says competition won't erode returns, moats will deepen, advantage will compound. Maybe, or maybe the very act of pouring capital into the same opportunity turns edge into average. Arms races are spectacular. They are also expensive. Under these stories sits a simple question that never trends. What is the return on all this? Not in sentiment, not in demos, not in headlines, on the income statement. If the answer is later, valuations become clocks. They keep ticking even when nothing breaks. And one day you look up and discover that time, not news, did the damage. Crashes don't require villains. They require crowded doorways. Here are the narrow hallways everyone is standing in. A few mega caps have become the market. Options flow, short-dated, leveraged, magnifies every tick, turning any rumor into a wave. Capital spending is colossal and front-loaded, while pricing power for the finished product is still being negotiated with the world. Financing is costlier than the zero-rate decade that taught investors bad habits, and regulators are writing the rules while the game is already in the third inning. None of this guarantees a collapse. All of it guarantees sensitivity. What lights the fuse? Not always a scandal, not always a war. Often something that reads like a footnote. A leader misses by a whisper. Transformational becomes disciplined. A data rule tightens here, a consent decree lands there. Power constraints slow a campus, a supplier slips, a guidance line that once promised faster now promises steady. The tape doesn't need catastrophe, it needs hesitation. When buyers stop rewarding the same words, sellers step forward to translate. The translation is brutal. It says, prove it. And when the proof takes time, time becomes the enemy. If the American market stumbles, the world does not watch from a safe distance. Wealth effects compress, ad budgets shrink, hiring pauses, credit spreads widen, risk flows reverse, money sprints from the edge to the center, from ambition to safety. The dollar tightens the tourniquet exactly when borrowers need slack. Exporters feel the chill before the news shows the frost. Tourism softens, property quiets, venture terms sheets vanish like morning fog. You don't have to trade to feel any of this if you run a studio, a shop, a startup. Your oxygen is confidence. When confidence thins, good projects still work. They just work harder. But AI is real. You say, yes, so was rail, so were canals, so were microchips. Reality is not the debate. Timing is. Every revolution arrives as a sequence: belief, build out, bottlenecks, shakeout, diffusion. Early investors win and lose fortunes at the same speed. Late adopters swear it was obvious all along, and textbooks pretend the path was straight. The question is not whether AI matters, it's whether today's price for tomorrow's cash is honest. If it is, the rally can live. If it isn't, gravity will finish the sentence that optimism started. There are signs worth watching, not predictions, just instruments on the dashboard. Breadth. Does participation widen, or does leadership keep narrowing to a smaller crown? Earnings. Quality. Do upgrades spread across sectors or cluster in the usual suspects? Language. Do calls say accelerate or rephase? The difference is $1 billion pronounced softly. Credit. Do funding costs glide or grind? Equity sings until credit coughs. Cyclicals and small caps, do they confirm the boom narrative or contradict it? Markets don't reward certainty. They reward adaptation. You don't need to guess the date of the next sell-off. You need to recognize the moment when the story stops carrying the price. So what does preparation look like in a world addicted to a single plot? Don't bet your life on one script. Diversify by cash flows, not slogans. Favor balance sheets that can fund their own future. Treat leverage like a borrowed parachute, helpful until the wind changes. Hold enough cash to turn panic into opportunity and separate your horizons. You can cheer for the technology of a decade while refusing to overpay in a week. Understand something uncomfortable. A repricing isn't the enemy of progress. It's the bill that progress hands to speculation. Sometimes the best entries appear when the dream is being marked down, not because the dream died, but because the financing changed. If a correction comes, it won't announce itself with thunder. It will seep in through language, through a guidance slide nobody screenshots, through a policy memo that reads temporary, through a chart that stops making new highs and starts making lower ones when no one is watching. And when the turn arrives, it will feel absurd until it feels obvious. That is how confidence ends slowly, then immediately. Some will say this is alarmism. It isn't. It's arithmetic married to memory. Bull markets end not because the future is dark, but because the price of brightness gets ahead of daylight. If you understand that, you don't need to be afraid of a break. You need to be ready to think while others remember how. The same system that lifts a handful of names high above the market will try to lower them to a more normal sky. The same options flows that made every rumor bullish will make every whisper heavy. The same investors who swore they were long-term will rediscover the meaning of until Friday. And the same commentators who explained why prices had to rise will explain why they had to fall. What happens next depends on a simple hinge. Can belief convert into billable reality fast enough? If yes, the market absorbs the test and keeps walking. If not, the crowd steps aside to wait for proof, and prices find out what they're worth without applause. History doesn't repeat, but money has a favorite rhyme: story, liquidity, concentration, then the exam. We're not guaranteed a crash. We are guaranteed a grading day. When it comes, don't look for villains. Look for the crowded doorway. Look for the words that changed meaning. Look for the beam carrying too much weight. And remember, technology is not a hedge against gravity. Discipline is. Markets don't ask your permission before they teach. They only ask whether you are taking notes. If this moment feels invincible, it's because the story is strong. If it feels fragile, it's because you're finally hearing the math behind the music. Both can be true at once. They usually are right before a turn. You don't need prophecy to survive what comes next. You need posture, curiosity over conviction, liquidity over bravado, systems over slogans. If belief becomes proof, the ceiling rises. If belief becomes doubt, the floor gets tested. Either way, history is generous with second chances, just not with those who ignore the first lesson, because in the end, markets are not temples to technology. They are mirrors for expectations. And when the mirror fogs, the smartest move is not to argue with it. It is to step back, breathe, and wait for the glass to clear so you can see the world as it is and price the future as if it has to earn its keep.